Yeah, so earnings season is now basically done, and we've got a much clearer picture of where the banks sit. What also happened probably on Friday, and I think you need to start with that, is that you actually saw probably CBA almost officially firing the gun in terms of what they're likely to start doing over the next sort of 6 to 8 months. And what I mean by that, we've been hearing that somebody like Ross McEwen, who's the head of NAB, we'd also heard Shane Elliott, head of ANZ, that they are talking to their customers about how they go forward. But what we got from earnings season, and Westpac's the one to really look at here, their 90-day delinquencies are actually higher now than they were at the height of the GFC. Now, their overall asset impairments aren't as big, but that is a real concern, that 90-day deferments are bigger than they were during the GFC. And what you're hearing from CBA on Friday is that they are now starting to discuss with clients about lending, about the amount of debt they hold, and actually starting to suggest to them that they should be starting to consider actually selling down debt. So that means actually selling property, that means selling business loans, etc., and what that means for them over the next 8 to 12 months. And that is the telling story, because what we're actually getting out of that, and what the suggestion is that there is a default cliff coming. That more and more clients sitting on bank balance sheets are actually now facing a scenario where they could default. And that therefore brings up a level of credit issue. It brings up a level of bad and doubtful debt scenarios for the banks. And it's a double loss. A lot of people sort of suggest that it's actually, the banks, are the big bad guys here. They don't want it because it actually impairs their credit. It makes their ability to borrow harder. It makes their ability to lend out harder. So they don't want to have bad and doubtful debts on their books. But it is clear the banks are now going, after going softly, are now having to have that hard conversation.
Well, not to mention as well, the more that happens and you're selling in a distressed market, the less likely they are to actually recoup the amounts.
Correct.
That's another issue. What are we talking about the main issues here? So you've obviously got owner-occupier loans, you've got business loans, or then you've got investment loans. Where do you think that the main stress is going to be felt from the indications?
Actually, you've almost perfectly labelled that out in the opposite direction. So it would probably start with investor loans in terms of how you would look at it from the point of view of the start point for the banks. They're the easiest ones for debt to come down in terms of how you would look at an overall client balance sheet, your investor loan, because the banks don't want to be kicking out owner occupiers. They don't want people to be all of a sudden in a scenario where the house they live in is no longer being able to be afforded and therefore being, inverted commas, put out on the street. So they would probably start with investor loans. Business loans would be next in terms of that space. That is a higher rate normally because a business is more risky than even bricks and mortar with a house loan that could be deferring. So that would be the next step, and then owner-occupier. So it's the investment market that you'll be watching closely. They're the ones that are already under stress anyway, but you perfectly hit it on its head, is that when a bank asks for a default, or when a bank basically, even if you are actually making a profit or what have you, the bank just wants the amount of money that they lent you back. But if the housing market or the business market has declined, as you alluded to, Tom, the loss is worn by you, because basically if you paid 100%, let's say the house price falls by 10% and the bank was already up to 80%, you've lost 10%. So your 20% deposit becomes half that size. So that's the other risk here, is that the wealth effect, the consumer confidence effect also gets hit off the back of this as well.
Yeah, well, storm clouds brewing. Let's hope it doesn't manifest. Just very briefly, here's an exciting headline. Australian dollar heading for parity. Is this likely?
Well, I don't know about parity, but it's certainly heading towards 80 cents. Parity we haven't seen since 2013. But the reason that's actually probably not a good thing, and I'll probably point that out there, is that at the moment exports for us have been incredibly strong and possibly giving us a little bit of a buffer to the overall headache that is COVID-19 and the issues that you've been alluding to with the Treasurer and what the Fed looks like. The reason it's a negative is that the more and more the Aussie goes up, the less we recoup from our exports, particularly things that are denoted in US dollars, which is most of our exports on the major side. The reason for it is actually the US Federal Reserve is on the warpath to actually start stimulating their economy even more so than what it's already doing. And it is at the levels it was during the GFC. And the reason the Aussie dollar is going higher is that our Reserve Bank basically has no more room to move in terms of what it's done. And it's telling us that. So the Aussie's got a falling US dollar. Our exports are actually doing all right. Overall, even with what's going on in Victoria compared to other countries, we're doing economically not too badly. All of that's actually a positive for the Aussie, and it's probably not the right time, unfortunately, for us to see an appreciating dollar.